Thank you all very much for coming along. It's great to have everybody here in person and people who are also online. It's great to see you as well. So what are we covering today? We've got our usual quickfire news items, which is going to be who have we got? We've got Sadiq doing this, and Marvin, who is our reporter in the Midlands. He'll be doing the indirect tax. We've got Jeff Webber, who I think pretty much everybody knows. Just a bit of a know everything about everything. He's going to do the mini budget. Chris and Francis, who are here in the room, will do incorporation of partnership and LLPs. Do fire your questions at us in the chat, please, and we'll deal with those at the end. Those are your speakers. So Sadiq is a manager on the tax line, knows nearly everything. Marvin Reynolds is a VAT director in the Midlands. Those of you who call the VAT line will know him very well. Jeff Webber knows everything about everything and everybody knows him. I've no idea who Chris Hens is. No, that's not true. I do know who Chris is. He's a director on the tax line as well. And Francis Evans is a tax director in the private client team and is, I'm being told, an expert on incorporations of partnerships, which is why Chris and Francis are talking about it. So just in case you wonder who they are, and I'm Malcolm Pengelly, I just stand here and make a prat of myself. So, so without further ado, Sadiq.
Yep, sure. Thanks, man. I don't need this, do I? Okay.
You can do it. Yeah. If you want to move the slides, you're going to need it.
Correct. It's good to see you all. Yeah. So I'm just going to cover 3 small updates since the mini budget. So the first one is quite interesting and potentially important. It's just come last week. It was an update from HMRC. So HMRC are now publishing new guidelines for compliance. So this is new guidance that HMRC are releasing. It's supplementary to their HMRC manuals. And basically HMRC are now giving their views and opinions on certain tax arrangements, really specific tax arrangements, whether they're low risk or high risk. And they're giving guidelines on what's good practice for advisors and businesses and taxpayers. So we don't know which topics they're going to release these guidelines for. They've only released one so far. It could be monthly, could be weekly. We just don't know yet. But so we're going to wait and see. What I'd advise for this one is bookmark the page. You should click on that link and bookmark it. There should be updates whenever they release new guidance on certain topics. The only topic they've released it so far is on PAYE settlements. So they've advised on what they believe is low risk and how it should be done. Okay, so the second thing I just want to briefly cover is HMRC's new agent authorisation guidance. This is specifically for digitally excluded clients. The 60-day CD2 reporting deadline, you can see there, that's still going to stay the same. It doesn't matter if you're digitally excluded, it doesn't matter if you've got access to online systems. Digitally excluded clients just means the clients that can't access the internet very well. So in order for them to authorise us to act for them, they're going to have to ring HMRC on the telephone or post HMRC giving us an authorisation. That's that. And the last thing I just want to cover is, so I don't know if you guys heard this, but in the mini budget on 3rd October, the government was really keen on, they did actually change the definition of what's a small business. So a small business now it's gone up from 50 employees to less than 500. So that actually hasn't interacted yet with the tax rules. So we don't know how this will affect transfer pricing yet. The RCAW are going to have conversations with the government to clarify how this affects the tax position. So at the moment, it's just reducing red tape for businesses with less than 500 employees. They have to do less compliance and regulations now. And that's it. That's all I want to talk about. And Marvin, over to you to talk about VAT.
Yeah, well, thank you, Sadiq. For those who don't know me, I'm Marvin Reynolds. I'm a director specialising in VAT. So I'm just going to start off talking about making tax digital. and the submission of VAT returns to HMRC. So MTD for VAT's been with us for just over 3 years now. Previously, it only applied to businesses trading above the VAT registration threshold. But from the 1st of April this year, the rules were extended to all VAT registered businesses. So including, for example, those that were voluntarily registered and intending traders. This means that all VAT registered businesses, apart from a very small number of businesses that are exempt, now need to submit their returns to HMRC in an MTD for VAT compliant manner. So despite the changes, it was still possible to submit VAT returns via the trader's online VAT account, so in the old-fashioned way. However, HMRC has announced that from the 1st of November, businesses will no longer be able to submit their VAT returns via their online account, hence making sure that returns are only submitted through MTD for VAT compatible software. So it's vital that traders that aren't already compliant sign up to MTD and also file future VAT returns in an MTD for VAT compliant manner. If not, there's a risk of VAT returns not being submitted on time and possible resulting penalties. So one further point, you may be aware that HMRC has recently introduced a new VAT registration application service, and businesses registered via that service should be automatically signed up to MTD, which is helpful. Second point I'd like to mention is options to tax. So this is where a business wishes to charge VAT in respect of a supply of land that would otherwise be exempt. The process is that a business would notify the option to tax to HMRC using the relevant form, and HMRC would then issue an acknowledgement of the option to tax in writing. The problem with the process was the time taken by HMRC to issue the acknowledgement, which could be problematic, particularly if there was an imminent transaction where the parties wanted some certainty around the option to tax. Before issuing the acknowledgement, HMRC would have carried out some checks to ensure that the option to tax was valid. So they may have queried, for example, the extent of the land to be opted, if this wasn't clear from the notification, or they may check the status of the person authorising the option to tax on behalf of the business. So, for example, making sure that they were an authorised signatory. Because of the time taken, HMRC recently undertook a trial. It wasn't very widely publicised, but under this trial, HMRC wouldn't carry out any detailed checks on the validity of the option to tax and would merely confirm receipt of the notification. So HMRC has now confirmed to several representative bodies that this process will be made permanent. HMRC is content that it's in line with their requirements under the law, and as far as we understand, they won't be issuing any further guidance or updated guidance on the kind of things that they'll do. So what this means in practice, well, hopefully we should now expect HMRC to confirm receipt of options to tax more quickly in the future, which is obviously a good thing. However, as HMRC will no longer be confirming the validity of an option to tax, this may give rise to some uncertainty. So whether it's valid or not, and may then also open up the risk of HMRC challenge at a later date. So what I suggest to businesses that have opted to tax is they should maintain sufficient records to demonstrate that an option to tax that they made is valid, because they may need to prove it at some point in the future. Also, if I was advising a buyer of a piece of land that's been opted to tax by the seller, they should carry out their own checks to make sure that that option to tax is valid, because if it isn't and the seller charges VAT in error, that VAT wouldn't be recoverable. So there's obviously a risk point there for the buyer. Just going to finish off talking about a couple of hot topic areas where HMRC are currently active. Firstly, HMRC are targeting the hospitality sector on the basis that HMRC believes that some businesses have underdeclared VAT by way of incorrectly applying the temporary reduced rates that were introduced following COVID. So you may recall that sales of non-alcoholic drinks in bars and restaurants, etc., were subject to a reduced 5% rate and later a 12.5% rate in the 2 years up to April of this year. HMRC is aware that some businesses selling mixer drinks, say a gin and tonic, put this through the till as 2 separate drinks. So gin with VAT at 20% and the tonic with VAT at 5% and later 12.5%. Whereas in HMRC's view, this should be one single supply of an alcoholic drink, and VAT should be due on the whole amount at 20%, rather than having mixed VAT rates. So this is something that, if you've got any clients in this sector, I think you should be bringing it to their attention because of the possible risk of challenge from HMRC. Secondly, we're aware of a campaign around prompt payment discounts. So the VAT treatment of prompt payment discounts changed from the 1st of April 2015. So it's going back a little bit now, but it's something that's becoming quite apparent that businesses aren't applying the new rules correctly. So prior to that date, the legislation on prompt payment discounts allowed all suppliers to account for output tax on the reduced amount that the customer would pay if they took up the prompt payment discount, regardless of whether the customer actually qualified for the discount or not, or paid the full amount. And the customer would reclaim input tax by reference to the discounted amount. So there's an assumption that the discount will be taken up. So from the 1st of April 2015, suppliers must account for VAT on the amount they actually receive from the customer, and the customer can only reclaim VAT on the amount they actually pay for the supply. So this causes some practical problems in that the supplier would initially issue a VAT invoice showing VAT on the full amount, that the customer could then reclaim the VAT by reference to that. But if the customer later qualified for the discount and received some kind of credit from the supplier, they would then have to adjust their input tax, so to make sure that they're only reclaiming the VAT on the reduced amount. So what HMRC identified over the last few years is that some taxpayer systems and processes are not correctly set up to make those adjustments. It may mean that the customer's reclaiming tax, then the supplier is accounting for output tax on. Hence, there's a loss of revenue there. So what they're doing is they're writing to businesses to try and identify those that have benefited from such discounts, and then they may follow up with questions to make sure that they've correctly reclaimed the correct amount of VAT. So there's kind of a couple of hot topic areas that we're seeing at the moment. So now I'm going to pass over to Jeff, who's going to talk about the mini budget.
Hello, I'm Jeff Webber. I'm one of the Taxline tax consultants, and I'm also one of the firm's specialists on stamp taxes and property taxes. Some of you may have spoken to me in the past on Taxline calls, but today I'm doing a very quick whiz through to give you all a heads up on the mini budget of the 23rd of September. One word of warning, we have already had one U-turn from the Chancellor on the proposed reduction of the 45% tax rate, and we're not convinced that there might not be further U-turns before the finance bill is ever enacted. So my comments are subject to those caveats. Natalie, can we have the next slide, please? So to start the quick run through, let's look at the first lot of quick highlights. The income tax basic rate reduction to 19% was originally not going to kick in until 6 April 2024, but has now been brought forward to 6 April 2023, but not for Scottish taxpayers, only for taxpayers in the rest of the UK. Despite the publicity that was given to the proposed reduction in additional rate tax from 45% to 40%, the reduction in basic rate from 20 to 19% is also pretty expensive as far as UK tax take is concerned. It just didn't have that publicity. As previously mentioned, the 45% additional rate was going to be abolished, but there was a very prompt U-turn, so it's now not going to be abolished. The corporation tax rate increase from 19% to 25%, and also the diverted profit tax increase from 25 to 31% is to be repealed. Now, this is also quite expensive. This is going to cost the government several £billion over the next few years, all adding to the black hole in the country's finances. Interestingly, in relation to capital allowances, the £1 million annual investment allowance limit is to become permanent. I should say permanent in quotes. because nothing is necessarily permanent. A new chancellor may come along, or this chancellor may change his mind, and we could be back to the default 200,000 annual investment allowance. The hope is that it'll stop yo-yoing now, and that the 1 million annual investment allowance will stay to give businesses a chance to do proper future planning. Also, the capital allowance super deduction rules will be changed to ensure that it will still operate as intended. It remains to be seen exactly what will happen and how much longer the super deduction will survive. It had been thought it might not survive, and it wasn't entirely clear that it would, but it now looks as though it will, but we are still awaiting details. The next thing I'm going to mention is something that was a pretty hot topic in the newspapers, that the 1.25% NIC increase has been reversed, or will be reversed, from the 5th of November 2022, and also the 1.25% corresponding dividend rate increase will be reversed, but that will be reversed from the 6th of April 2023. Now, the reverse will apply to regular employees. It can't easily be applied to directors who are charged on an annual basis, and there is going to be a composite rate both of employee and employer NIC for the whole of 2022-23 for directors who are charged to NIC on an annual basis. Finally, the health and social care levy that was proposed from 6 April 2023 is going to be dropped. Now, interestingly, the proposed NIC increases in the health and social care levy were supposed to fund additional costs in the first instance in the NHS, and subsequently in our care arrangements, aged care arrangements. There's been no comment from the Chancellor on how those increased requirements might be met. But interestingly, earlier today, the Prime Minister confirmed that there is going to be no reduction in general expenditure. Now, given that there are tax reductions and no reductions in general expenditure, it begs the question of how this is going to be financed. And the only obvious way, of course, is through additional borrowing. But I think we're going to have to wait for further comments from the Chancellor and the Prime Minister on that. Next slide, please, Natalie. Moving on to further quick highlights. The IR35 changes that were made after a very long consultation in 2017 and 2021 are to be repealed. Now, I'll be looking at this in more detail in a later slide. Moving on to investment incentives, in an attempt to encourage more SEIS investment, the annual individual investment limit is going to be doubled from 100,000 to 200,000, and the investee companies limit is to be increased to 250,000, and gross asset limit increased to 350,000, which is obviously a good encouragement for SEIS investment. Additionally, the CSOP annual individual limit is going to be doubled from 6 April 2023, and the worth having conditions are going to be removed. Also of interest is that the EIS and VCT tax reliefs, which were originally time limited until they expired in 2025, it appears are now going to be extended. We've not got details yet, so further details are awaited on that, and we will see what appears in the finance bill probably in the new year. As far as stamp taxes is concerned, the SDLT nil rate band is being, or has been, increased with effect from the date of the mini budget from 125,000 to 250,000. It's doubled. And as far as the first time buyers relief is concerned, their nil rate band will increase to 425,000, with the threshold for value of the properties qualifying for the enhanced nil rate band increased to 625,000. Sorry, there's a typo there. That should be 625,000. So that will cover a very large proportion of properties outside London and a reasonable number of properties in London and the southeast as well. In an attempt to improve our rates of investment zones are being set up with tax benefits for 10 years. Again, we'll cover this in a little more detail later, and there will be planning relaxations. And finally, I just mentioned that the VAT-free shopping for overseas visitors is to be introduced, quote, as soon as possible, obviously intended to encourage more tourists to the UK. Natalie, next slide, please. All right, one interesting point concerning the no longer going ahead of the increase of corporation tax to 25% is the fact that it has already been legislated in FA 2021, so it is now in use for any deferred tax calculations that are needed for a company's accounts, which means that the 25% rate in relation to deferred tax must still be used until the legislation to repeal FA 2021 provisions is enacted, and that is presumably going to be in FA 2023. It will be the case that in many cases the difference, a 6% change to the deferred tax calculations, could well be material. So it looks as though notes to the accounts may be required to explain the issue. On the basis that the changes will be included in a finance bill, presumably Finance Bill 2023, and on the assumption that it will be enacted by 31 March 23, our expectation is that the 19% rate would be both substantively enacted for the purposes of IFRS and UK GAAP, and will actually be enacted for the purposes of UK GAAP from Q1 2023, which means that the 25% rate for deferred tax will continue to be used for quarters 3 and 4 in 2022 as far as US GAAP is concerned, and 31 December 2022 calculations for UK GAAP and IFRS. The practical issue, another practical issue, is companies which have non-calendar year ends will need to review the position to determine the enactment status. I mean, we're assuming it's going to be enacted by 31 March 2023, but there's no absolute certainty of that, which means that the status of presumably Finance Bill 2023 will need to be carefully monitored. Next slide, please. Right, a very hot topic. IR35, the new legislation in 2017 and 2021 rules. These are being repealed. These rules were highly complex and controversial and applied first, of course, to the public sector and from 2021 to the private sector as well. And they imposed what we describe here as a significant administrative burden for many business owners. So their removal from April 2023 is welcome, but it's not straightforward. There are downsides as well as upsides. I mean, many businesses have invested a great deal of money in getting their systems right for these rules. So all that is going to be pushed to one side. It's not going to be of much use. Additionally, many of the engagers, that's the end users, own responsibilities for their labour supply chain remain. And I've just included a few points here. The rules don't change until next April. So any contractor engaged between now and then, the engager will still have the 2017 and 2021 off-payroll labour responsibilities to contend with, and we do expect HMRC to enforce them rigorously, assuming HMRC, of course, has got sufficient resource. The second point here is that employment status issues can, of course, equally apply to self-employed contractors not using a personal service company. So the end user is still going to have to take a view as to whether somebody who is taken on as a contractor genuinely is a self-employed contractor. And it should be borne in mind that in some cases, under the 2017 and 2021 rules, companies took the prudent approach and put some of their contractors onto the payroll. And if they now suddenly decide to take them off the payroll and treat them as self-employed, it's likely to be looked at pretty closely by HMRC. So we advise great caution here. Now, other relevant legislation is involved, including the agency rules, construction industry scheme, managed service company legislation. None of that has changed. And if they're retained long term, we do expect a closer focus on compliance with these rules from HMRC. What we don't know, of course, is whether HMRC is going to have sufficient resource to police these rules as strictly as we think they might. Time will tell then. And finally, as I've already mentioned, if businesses have dealt with the off-payroll labour rules by taking workers onto the payroll, automatically unravelling these arrangements may not be the best course of action. It might be pretty provocative to HMRC, so great care is needed there. Natalie, next slide, please. Finally, we're having a look at investment zones in England. The legislation does not currently apply to Scotland, Wales and Northern Ireland, but the government has stated that it wishes to work with the devolved Scottish and Welsh government, and presumably the Northern Ireland government when it reconvenes, to create investment zones in those regions. I've no idea what the devolved government's response will be to that. I don't think there's universal approval, but again, time will tell whether the devolved governments wish to cooperate. They may not want to lose out, of course. So what have we got as tax benefits which will last for 10 years in the investment zones? There'll be 100% first-year enhanced capital allowance relief for plant and machinery, and there will also be accelerated enhanced structures and buildings allowance relief, 20% per annum. Helpfully, there'll be 100% relief from business rates on newly occupied business premises and also on existing businesses where they expand their premises in an investment zone tax site. As far as SDLT is concerned, there'll be full relief for land and buildings bought for use or development for commercial purposes. So that will cover existing buildings and land to be developed, and also purchases of land or buildings for new residential development in investment zones. We've absolutely no idea how that's going to pan out in practice, building residential property in a fairly industrial investment zone. Again, we're awaiting more detail, and we'll see what the property industry has got to say about that. And finally, on the tax benefits, there will be zero rate employer NIC on new employee earnings up to just over £50,000 per annum. So good news there. Just a few other points to finish. The planning regulations are to be relaxed in these investment zones. No idea what the local authorities and local people will think about that. I would have thought there's going to be a certain amount of NIMBY resistance, but we shall see. Interestingly, the existing free ports will also be able to apply, and we haven't got details yet, but the idea, we think, is that free port legislation will work side by side with investment zones. Again, detail is awaited from the government, And as I mentioned before, the government wishes to work with the devolved governments, and we will see how that pans out. That's my summary finished. I'll now hand you over to Chris and Francis to deal with incorporation of partnerships and LLPs.
Thank you very much, Jeff. Hopefully you can hear me through the microphone. I'm Chris Holmes, backline consultant. I'm pretty sure most people know who I am. Joined here by Francis, who is the director in our partnership team in PCS, who also have the grand title as being the champion of incorporations for the firm. I happen to assist her in that, support her in that role, but so we both do a lot of these things. And in particular, I'm going through a couple of pretty major incorporations at the moment and some pretty big businesses. So this felt like an opportune moment to give you some of the intel that I've learned from doing it. Primarily, we are looking at incorporations of trading and professional partnerships. A lot of what we're talking about equally applies to property partnerships or sole trades. We're just concentrating on the professional and the trading side of things. So we will briefly talk about properties when we come to incorporation relief. We shared the slides out between us, but we'll probably interrupt each other as well at a few times, opportune moments as well. Well, I'll interrupt Francis. She wouldn't dare me. But right. So why does someone incorporate? There's lots of commercial. I'm sure we've been through these a lot. Most of you will know this. There's lots of commercial reasons why someone might want to incorporate. You will have had the experience and gone through that list. So I'm not going to go read through this list. When it comes to professional services, we're finding that a lot of the thing at the moment is it's about accessing capital. I'm doing one at the moment where they're looking potentially going an IPO. So restructuring a law firm to go to an IPO is what I'm looking at. There's another one I'm doing at the moment where they're looking at they're going to be bought out by a listed group, so they need to put it into they're going to basically be bought out, so the LLP is going to go underneath the group. So there's lots of reasons why we end up doing these sorts of things at the moment, as well as your normal high street partnership might be wanting to incorporate for various reasons. So I'm not going to go into detail though. Fran's going to quickly mention some of the tax benefits.
Yeah, so I very enthusiastically started a conversation with a gentleman in the audience about how the accountancy industry had changed over the last 20 years and thinking forward about how it might need to change and would you need money for that. And generally, we all accept that if you're taking all of the money out of the business, a partnership, a self-employment, you tend to pay less tax on that. If you're reinvesting those profits, a corporate entity might be the right answer. So if we're all thinking we're going to have to spend lots and lots of money to make our businesses ready for making tax digital, maybe that's a very cost-effective way of doing it. But if we're expecting all of our partners to want to be paying their school fees, their mortgages, they're taking all the money out of the business, maybe partnerships is the way to carry on. So thinking about what it is the business is trying to achieve is a really important factor when considering incorporation relief. There's some other things around tax. Maybe the business is doing lots of R&D. Partnerships don't qualify for R&D tax relief. Maybe they're spending lots and those super deductions on capital allowances, also not available to partnerships. So there's some other reasons that are falling into play into why incorporating might be the right answer for the business. And let's not forget basis period reform. Maybe you've got a business that really is wedded to its year end, but doesn't want to have to fall in line with basis period reform. Is that a reason to incorporate? Maybe, maybe not, but just throwing it out there.
Right. First example we're talking about, this is one of the traditional one from our TSP client base. We often talk about this in the past, where people simply incorporate by selling to the company and leaving a rather large balance on the director's loan account, claiming BADR, so effectively paying a 10% uplift in the value of the business now, and having the ability to draw your profits out for a few years and not pay any more tax. That was always very attractive. A lot of our client base went through that with their clients. However, it became far less popular since behaviour was restricted on goodwill or customer-related corporate intangibles, and also the restriction on companies from amortising their goodwill on purchase goodwill from related parties. So it became a very unattractive way for go forward. So now people are looking at the more traditional ones, which of incorporation relief and gift relief, which Francis is going to talk about first.
So when Chris and I talked about this slide, we called it bog standard incorporation relief. So selling the business in return for the issue of shares, and there's some restrictions. Your business, your partnership can't have corporate members, so that's one thing that you've got to think about. Another point is it a business? Chris touched on that in terms of property.
Yeah, I mean, I think most people know Elizabeth Moy-Ramsey. Most people know who have probably done property partnership and corporations and know the definition of business. So I don't think we'll go any further in that. So
sometimes one of the problems that we come across when we're looking at this in real life is we don't want to move all of our assets. So that's one of the things that we're often looking at and thinking about. Is there different ways of doing this? And also it's key to understand that what you're doing is receiving shares, and the base cost of the shares that you receive is being reduced by the incorporation relief effectively. So thinking further down the line, what are you going to do with this company? Are you looking for an exit in 3 to 5 years' time? When you exit out of that, will you be selling the shares, or will you be selling the trade and asset from within the company? If that's something that is of a consideration, you need to bear that in mind when thinking about this.
I think the last point, Newco must carry on the business. We had this, Francis and I was working on a propertised law firm, and they were trying to spin out part of the business. So we could have got round the whole, all of the assets by putting it into a separate partnership first. But the problem was we were going to incorporate into a new company, and then the new company was going to be bought by another company, and then the trade was going to be hived up into the original company. And they were going to do it all on the same day because they didn't want to go through all the regulatory requirements, have to register the new company as a trading with the law society and all that sort of thing. So we basically had to trade on the same day, leaving the partnership into a new co, then being bought out, and then going up into because we couldn't turn around, we couldn't meet the requirement. The new co was carrying on the trade as a matter of fact afterwards. Incorporation relief didn't apply. So we need to be careful of some of the very specific wordings in the legislation that can catch you out. So in that case, we went through this option.
And this is where I hold my hand up and say, I'm the firm's incorporation relief champion, but I mostly use gift relief, because when I look at the specific situation of what I'm trying to achieve, I can make it fit into gift relief a bit more often than I can incorporation relief. So I feel like I'm kind of missold myself as incorporation relief champion. But this is what we turn to when incorporation relief isn't going to work. When we're not trying to move all the trade and assets, when there's circumstances that means that we can't fit into that, just as Chris outlined. So we do need to think about some of the restrictions. Again, we want our partners to be individuals, not corporates. The assets must be used in a trade. Again, definition of trade, think about what it is that we're moving and whether they're used in that trade. One of the ones that's not written on here is we can't be gifting it to a non-resident. And we've also got to be mindful of if the people we're gifting it to or will become non-resident, that might cause us some issues. So thinking about those restrictions as well. And there's a joint election that you have to fill out. The client that Chris and I worked on, where we turned to gift relief, how many of these forms do we need to sign? Who needs to sign them? How are we going to get them to HMRC? That was definitely a set of questions. That was
over 400, if I recall. It was a large law firm. Yeah, and the finance director was able to sign every single one of them.
And then, of course, because the partners are submitting their tax return electronically, he signed them, but we're attaching them electronically. So it was a bit random. So yeah, so there's lots of things to think about, and the commercial aspects are really the important points.
So the main difference between this and incorporation relief is actually the base cost of the assets in the hand of the company. Because in the incorporation relief, the base cost of the assets is the value of the assets when it acquired. So the full market value. In this one, because the gift relief is being held over against the assets in the hands of Newco, the base cost of the assets is effectively the original base cost. As far as the shareholder is concerned, the position is roughly the same. Previously, the share and the incorporation, we're holding over the gain against the shares, which you receive market value. When you knock off the value, come back down to a pretty low figure. In this case, Newco's base cost in shareholders' hand is going to be the price that they paid for those shares, which is probably going to be £100 or something. So it's got nothing to do with the value of the business. It's how much have we subscribed for these shares. So I think in the case I'm doing at the moment, we're talking about £50,000, and that's only because it's a list. We've got to go for a PLC. So yeah, so that's the main difference. So if we can get incorporation relief, the benefit is that you've got a bigger value of assets in Newco, and that is going to make a difference if you do have property, because obviously you kind of sell Newco later on, the shares in Newco there, a buyer will go, well, there's a big premium gain on those properties, and they'll want to negotiate on the discount. When it comes to professional service firms, that really isn't an issue. I mean, you're rarely going to sell the trade. You're more likely to sell the shares and the assets. And actually, people buying a company are not interested in the underlying base cost, because they're only ever going to sell the shares as well. So that's something we do very much. So which is why for professional service companies, as Francis says, we do quite often use this one. And I've used this more times in corporation relief as well. Right, a spin. I have found the two I'm doing at the moment actually want to retain the LLP in the structure. So rather than transferring out the trading assets of the partnership into a company, we're actually transferring out the membership interest. Now, these are where they're LLPs. I don't know that you can necessarily do partnerships, but certainly for LLPs, we're giving away. So we're transferring out, we're selling, or we're giving away the membership interest. So the disposal is actually happening at partner level, not at LLP level. Lots of reasons why you might want to do it. The main ones that on the case I'm working at the moment is all around avoiding the need to actually transfer what is a multi-million pound trade. It's a £200 million value trade. I mean, it's a huge thing. But they've also got, I don't know how many people understand about professional partnerships, but when you go, especially with law firms, if you work into another jurisdiction like Scotland, where there's restrictions on ownership. So in Scotland, you can only share profits with Scottish registered lawyers, a bit like you used to in the UK. What you can do is you can set up what they call valve partnerships. So you have a couple of partners who are common in both, and you adjust which partnership they get their profit share from. And that means that the balance of profits allocated to all the other partners can be adjusted. So you can adjust the profits how you want to by using this. So you need a partnership to do that. You can't do it with a company. So that's a reason, because the one I'm talking about are thinking about moving into Scotland. So that's going to be a key part. There's also I think in the law firm, they really do think, partnership culture is so important for some industries. Lawyers in particular, they like the idea of partners. So once you decide you're going to have the partners, that you're going to retain the LLP in your structure, the then question is, well, what do you do with the partners? Do you have them put them in as employees? Do you put them in do you keep them as partners? And there's all sorts of issues around that. The ones I'm doing at the moment, I think they both want to keep them. But the one I did last year, they actually went as in as employees. The reason why you might want to retain them, it's really, especially in law firm, and they were quite adamant they wanted the ability to make staff lawyers, because apparently, make the staff partners, because apparently this drive for, it's just a desire to be a partner in the law industry. I mean, I don't think we've got any lawyers here, but I may be talking out soon. But that's what the excuse we're doing. There also happens to be an NRC saving, not having to pay employers, Nick. Now that obviously we don't want to say we're doing it for tax reasons, but that is sometimes a thought behind it. But it's the commercial driver is more, in the case is more around this topic. If we do end up with individual, well, if we do actually end up with both, we do have to take a lot of care over the mixed members rules. In the 3 cases I've done where we kept the LLP, 2 of them we've ended up going to council and mixed members, and they're very close. And it might be the last year one, they actually were leaving, they're becoming employees, but in the year of change, technically, because it happened halfway through the year, technically they were partners at one point and there were shareholders of the company others, so that fell squarely within mixed member rules, even though at no time were they both, because they were both in the tax year. So in the year of change, we had to look at it. And the current, and the one I'm doing now, I mean, it really is, it's going well. It is a big deal. Salary members rules, you tend to find if after this, the partners tend to have a fixed share because they also, their variable share comes through their dividends from the company. So we've got to look at 6 salary members rules. So, I mean, usually we'll walk around there with fixed members by, as long as they've got capital in the business of 25 equals 25% of the fixed share, we're okay. But that, if we fall foul of that, then they'll just subject to PAYE. So there's a few things you've got to be careful of when you do all these things, but I mean, it can be complicated. No, so let's go through a couple of the actual mechanics. Right, this is, if we were to sell the LLP interest to the newco, yeah, doesn't matter if it's for shares or cash, you will not get incorporation relief if it's for shares because there's no transfer of the share of the trade. It continues within the LLP. So there simply is no incorporation relief. So it can be shares, it can be cash, it can be a combination of both. And it's simply thinking about it in the normal rules of those sort of things. Now, the one I'm doing at the moment, the sale, this newco is actually owned by a big US LLC, and our guys are getting less than 1% of the ownership of the PLC. So we do not fall foul of the 5% test on the BADR. So they will continue to get BADR, and as their profit, their average consideration is about 1.3 million. They're quite happy to get £1 million of that at 10%. So they've all elected as a group, let's go through it and let's do this. They had this in the choice of gift. They decided to go for this. We'll pay it up front, get a 10% tax on it up front, and bank our BADR. That's basically what they decided in this case. So that is an actual sale of the LLP interest. So yeah, of the members' interest. The alternative is gifting it. Very similar to what Francis was discussing before. You basically, instead of, you set up a newco and you gift the membership interest in, and as long as the ownership of the company mirrors the ownership of the LLP, no one's losing any value. And that's what we're doing in my other case, where we're actually looking for a listing. We've set up a newco, we're going to do this, and then after the newco has been done, we're going to put the PLC over the top to a share exchange and list the PLC. Unfortunately, they're still going to own about 60% of the PLC afterwards, which is why we got all the issues with mixed member rules and such like. So so what have I said? That we got exactly the same restrictions on 165 that Francis mentioned before, and in my case we got 320 holdover claims to get signed. Yeah, so I think that's about that. One final point. In the next few weeks, we got, I have a tax journal article on 165, everything you want to know about 165 holdover. So keep your eye out for that. We will share it through our e-zines. We'll share a link to it when we can. Any questions? And that's for all sessions. I'll hand over to Malcolm. And
thank you. Thank you, Francis. Thank you, Chris. If you've got any questions, I'll take questions in the room to start with. Anybody online who's got questions? No. No. Is there anybody online?
They are on 30-second delay, so let's give it some time.
Okay. Well, you've got a few seconds while I ask questions in the room to pop some questions in the chat if you're online. If there's anybody there. Any questions from the room? Yes, Claire.
Do we know yet what will happen with section 455 when the numbers change about what you have to pay?
Where's Jeff? Yeah, are you there?
Yeah, I'm still here.
What's
Can
going
you
to
hear the
happen?
question?
There have been no there have been no detailed announcements on this. Yeah, obviously, if the rate of corporation tax changes, one would expect the rate of 455 tax to change. If it's not changing, the expectation would be that the 455 rate won't change, but the Chancellor has simply not given any details or yet given any indication. I think we're awaiting more comments from the Chancellor on this, but my guess would be that if corporation tax rate is staying unchanged, then 455 will be unchanged.
Well, it's usually paid at the higher rate of dividend tax, isn't it? So if that's it's not the additional, it's higher rate, isn't it?
Yeah, but I mean you know, with the lack of reduction in 45%, and I mean generally the revenue are looking at the rate of corporation tax and the rate of dividend tax. So if nothing is changing, then I wouldn't expect 455 to change. But we must wait and see what the Chancellor has got to say. Almost certainly he's going to be coming out with more details between now and the end of the year.
I would expect, because I think at the moment you've got the 1.25%, haven't you? I'm expecting the 1.25 will disappear, but probably from next April. But who knows?
Yeah.
That it was for this complete tax year, you've got 1.25 extra.
Yeah.
It's tricky though, isn't it? Because companies don't tend to have 5th of April year ends. So what a strange date to use for a change of section 455.
Yeah, that usually runs the 1st of April, doesn't it? I think.
Yeah.
Tax year. But
I mean
who knows?
the problem was that the mini budget was very short on detail, and we're awaiting more detailed comments. I think part of the problem may be, for example, not so much this, but with IR35, there's the distinct impression that the Treasury went ahead and did it without even asking for comments from HMRC, and there's little evidence that the Treasury has consulted HMRC on many of these mini budget proposals, let alone details. I suspect they're consulting now, and we can expect details once HMRC have run it through their calculators. But until then, we can only guess.
It's the definition of first-time buyer for SDLT relief, and whether there's any change.
Oh no, well, again, we haven't seen detail, but there was no suggestion there's going to be any change in the definition of a first-time buyer. I mean, the definition has always been fairly tight, and I can't see it being relaxed. My guess is it will remain the same.
Are husband and wife treated as one? I can't remember off the top of my
Yes,
head.
they are, and civil partners too.
Chris, I have a question. You know, you said about incorporation relief under 162.
Yeah.
And you said there's no goodwill, you don't get relief from the goodwill. What about this? You said something about the 5%. What,
If you're selling your business to a company,
yeah,
we used to get you used to claim BADR on the whole amount.
that's right.
Yeah. There's basically a restriction on the availability of BADR on goodwill and customer related
Right.
intangibles. There's a bit of a carve out for registered trademarks, but let's ignore that for a moment. And it basically says that if the company buying it, you or an associate has more than a 5% interest in,
Right.
you do not get BADR on that goodwill. Yeah.
Right.
Now, for this purpose, partners in a partnership are associates of each other. So, or if we just maybe got 400 partners, as we found when we were doing the one last year,
Yeah, I know.
none of them apply. No one's at 5%.
Less than 5%.
Yeah, there's actually there is another carve out that says if it's done in preparation for the sale of the company within 28 days
Right.
to a third party in which you do not hold the 5%, then you can still get it, but there's quite a strict carve out for that one. So yeah, just to be complete.
Thanks very much.
That's right.
Any more questions in the room?
There's one on VAT I have.
Go
I'm
on
not
then.
quite sure.
Marvin, are you with us?
Is the discount?
Yes, I'm still here.
Okay, is the early payment discount, you said, so if a customer issues an invoice saying if you pay £1,000 plus VAT within 10 days, I'll give you 10% discount. And I thought the old rules was that the supplier would claim the full VAT input tax. Does it, I think what you said was, would that be revised now? I mean, what is the rule now? I mean, you have to issue a credit note or something, or what, to adjust the VAT element?
There's a couple of ways to do it. So HMRC would allow the supplier to state on the invoice effectively the full amount of the VAT, but with a comment to say that, you know, if the discount's taken, then the VAT amount would be such and such, or a lower amount, or it could issue a subsequent credit note. So there's a couple of points there for the supplier. The issue is then, though, that if the supplier adjusts its output tax, because by reference to the amount actually paid by the customer, but the customer then doesn't adjust its input tax to reflect the lower amount, then the customer has reclaimed too much input tax. So that's effectively what HMRC are looking to identify.
Right, okay.
Because the supplier should have reduced its output tax, but then the customer may not have reduced its input tax.
Right. Okay, thanks.
Any more from the room? If not, we'll go to Natalie. There is nobody there, is there?
They're going to sleep. I hope not.
In which case, can those online, if they've got feedback, please have some feedback. We'd love to have your comments as to how this event has been for you. Please drop that in the chat box. Don't be shy. It's only going to be looked at by Natalie. It's very discreet. And for those of you in the room, if you take a few minutes to put in your feedback forms, which are in hard copies, that would be fantastic. Our next event is Wednesday, the 16th of November. Details will be coming out shortly, but I think it's an afternoon. Thank you very much for joining us.